While the market is busy chasing the next big thing, the world's most famous investor is making a fortune by not doing much at all. Berkshire Hathaway, the company Warren Buffett built, is now sitting on a mountain of cash that has smashed all previous records. As of its first quarter 2026 filing, the company's position in cash and US Treasury bills reached nearly $400 billion. That's more than the entire economic output of countries like Norway or Hong Kong. This isn't an accident, it's a deliberate defensive move. And what it signals about the hidden risk in today's market and maybe in your own portfolio is something every investor should understand right now. So, why is this happening? The simplest reason is the Buffett and his team aren't finding enough attractive opportunities to invest. In a recent meeting, Buffett's successor noted that it's difficult to find best deal at a valuation they are willing to pay. This isn't a new strategy, it's a classic discipline. When prices are high and the margin of safety is thin, Buffett prefer to wait. And this waiting game has been surprisingly profitable. With short-term US Treasury bills yielding around 4 to 5%, Berkshire is earning billions in virtually risk-free income while it keeps it dry powder. The cash isn't just sitting there collecting dust, it's compounding while it's wait for better opportunity. This makes the decision to wait much easier than it was in a zero interest rate world. For many quarters, Berkshire has been a net seller of stocks. In the first quarter of 2026 alone, the company has sold $24.1 billion of equity while purchasing only about $16 billion. This trend of selling more than buying shows a clear defensive posture. There is a famous metric that Buffett himself once called probably the best single measure of where evaluations stand at any given moment, the ratio of the total stock market capitalization to the country's GDP. Today, this Buffett's indicator is at historically high levels. Depending on the exact data source, the ratio stands between 231% and 234.5%. For context, while there isn't a direct playing with fire quote, Buffett had made it clear that such high valuations are dangerous territory. While the indicator isn't a perfect crystal ball, its current reading suggests that the market may be significantly overvalued. It implies that investor optimism might be outpacing actual economic growth. Buffett has also commented on the gambling mood in the market, noting that many stock prices seem silly and that speculative behavior is rampant. This sentiment aligns with his company's decision to hold back instead of deploying capital aggressively. This isn't the first time Buffett has shown restraint during a period of market mania. He famously sidestepped the worst of dot-com bubble by refusing to overpay for tech companies he didn't fully understand. Heading into the 2008 financial crisis, Berkshire's liquidity allowed it to make incredibly lucrative deals after the crisis was already underway. At a time when other institutions were desperate for capital, the current cash hoard sent a similar message. It's not necessarily a prediction of an immense cash, but a clear signal that the risk versus reward balance in the market is not favorable in his eyes. As Buffett has said about the market downturns, the best time to buy is when markets are collapsing and nobody else want to. This strategy of patience and discipline is a powerful lesson. But how can you apply this principle to your own financial journey without having billions of dollars? To start, it helps to understand the foundational rules of long-term investing that protects you from making emotional decisions. So, should you sell everything and hoard cash? Not exactly. An individual investor situation is very different from Berkshire Hathaway's. The company is so large it needs elephant-sized deal to move the needle, and those are currently scarce. However, the principle behind Buffett's strategy are timeless. First, don't force an investment when you can't find good value. Patience is a virtue in investing. Second, maintaining some cash or liquidity reserve gives you flexibility and protects you from being a forced seller during downturn. Finally, focus on quality of businesses you are buying, not just the momentum of the stock price. Buffett's own advice for most people is even simpler. He has long recommended low cost S&P 500 index for the long haul. In his will, he instructed the trustees of his wife's benefit to put 90% of the cash in an S&P 500 fund and 10% in short-term government bond fund. Berkshire Hathaway's massive cash pile isn't a sign of fear. It's a masterclass in discipline, patience, and risk management. It's a statement that in market that feels expensive and speculative, sometimes the most profitable move is to wait for the right pitch. By refusing to chase fleeting trends, Buffett is positioning Berkshire to seize opportunities when others are forced to panic. For the rest of us, it's a powerful reminder that building wealth isn't about constant action, but about having a sound strategy and the temperament to stick with it. Make sure you subscribe to the channel. See you in the next video. Take care. Bye bye.